5 Key Lessons from the Intelligent Investor Most Will Never Learn. It would be a little foolish to have never read The Intelligent Investor by British-born American Benjamin Graham before pretending to be an investor, given that it has sold over 1 million copies and has been called by Buffett by far the best book on investing ever published. The book, which was first published in 1949, strikes me as astonishing because of how current it still is more than 60 years later. This video discusses value investing as a topic and investment strategy. In 1928, Graham started instructing, which he subsequently improved with David Dodd. At age 19, Buffett read The Intelligent Investor and decided to study under Graham at Columbia Business School. Graham and Buffett later became longtime friends. After that, Buffett continued to work for Graham at the Graham-Newman Corporation for 2 years until Graham made the decision to shut down the company and retire. The rest is history, as a number of Graham's clients subsequently requested that Buffett manage their assets. Later, Buffett created his own investment approach, which was distinct from Graham's in that it placed more emphasis on asset quality and called for holding stocks indefinitely. Graham would usually opt to liquidate an investment when it reached a specific price. However, according to Buffett, nobody ever lost money when they followed Graham's strategies and recommendations. Here are only 5 of the most important principles I learned from this fantastic book. 1. Learn from your mistakes and never give up. The 1929 stock market crash and the ensuing Great Depression caused Graham to lose the majority of the wealth he had amassed. Although many would have given up on investing after learning a painful lesson about risk, Graham went on to produce Security Analysis, which described his techniques for analyzing and evaluating assets. He achieved this by purchasing the stocks of businesses whose shares were trading at a large discount to their liquidation value. It is reported that during the course of his many years of managing money, Graham still managed to generate an annual return of about 20%, despite all the hardships of the Great Depression. 2. Investing is neither speculating or gambling. Even though buying stocks was seen as nothing more than a pure gamble at the time Graham accomplished his tremendous results, he was ultimately able to do it with great returns and a low risk. According to Graham, an investment should guarantee the return of the money invested and provide a profit that is more than the rate of inflation. He did this by challenging the commonly held belief that markets are efficient and pledging to find assets that were undervalued. This is known as value investing or intrinsic value investing. Mr. Market, an irrational man who politely provides you a buy and a sell price for your assets every day, was a brilliant analogy that Graham used to explain the market. Unfortunately, Mr. Market is a bit of a manic-depressive character who occasionally offers prices that are wildly enthusiastic or even absurd, but on other occasions can only see doom and gloom and offers prices that are incredibly depressed. According to Graham, it is up to you as an investor to consider or reject Mr. Market's interests. The key, he said, is to see Mr. Market as your ally and use his kind offer of regular prices to your benefit. Buy when he is depressed and sell when he is on a high. 3. Minimizing downside risk. Graham frequently emphasized the significance of purchasing investments with a margin of safety and doing so below actual or intrinsic value. This is significant because it enables upside profit when the asset eventually revalues to fair value on the market. However, if things don't go as expected and the market declines, the margin of safety strategy also offers some protection on the downside. Graham would consider a company's liquidation value when valuing its shares. Investors in real estate may, for instance, take into account land value to reduce downside risk. 4. The margin of safety. The fundamental principle of value investing is to purchase assets at a discount to their intrinsic value and hold them until their price reaches their intrinsic worth, generating a return on the investment. Graham declared that his objective was to purchase assets worth $1 for only 50 cents. And he was successful in doing just that. He could accomplish this in one of 2 ways. Utilizing market psychology was the initial strategy. In other words, he took advantage of the market's fear and greed. The second was to invest based on statistics to locate inexpensive assets by investing countercyclically at times when the market was pessimistic and deals were plentiful. 5. See beyond the horizon. Graham once said, "In the short term the market is a voting machine, in the long term it is a weighing machine." There will always be Chicken Littles there to warn you that the world is ending and that now is a bad time to make an investment. We have no means of predicting what the markets will do in the near future. The market will eventually return to its mean value and represent intrinsic value, albeit, in the long run. Find assets that will be highly sought after in the long run, purchase them, and cling on to them. That, in a nutshell, is intelligent investing. If you have enjoyed this video and found it useful, please give it a like and subscribe and check out the other videos on my channel that will help you with your investing life. Also turn on the bell notifications so you don't miss a future upload. Thanks for watching and I will see you all next time.